Well, let's get started with this Q&A with all the questions you've been sending us, in which my colleagues are trying to group into blocks of questions so that we don't repeat them. Remember, you can keep on sending us your questions through the text box, which appears under the signal. And that's it, let's begin. Let's start straight away with the first questions that are coming in. So let's start. To clarify, when you were talking about the dream in 2025 of the 1 billion in Ebitda and the 500 million in income, does this include inorganic? Well, we've mentioned that at an organic level, we have 5 major goals. We talked about sales, of growth that far outperformed the market. We talked about growth in margins that reached over 19%. We talked about very important control over capex. We talked about 2% tax payment. And we talked about a considerable cash generation over the period. Over 2 billion in cash generated. Of course, with this cash generation, we can tackle inorganic growth and with it achieve the dream of obtaining 1 billion euros in Ebitda and 500 million euros in net income. So, to answer your question, yes, the dream includes inorganic growth. So let's continue. In the last few years, the CIE sales pie chart has been showing greater weight of OEMs compared to Tier 1. Why has this happened? And, talking about OEMs, how have you been affected by the mergers between OEMs that we've been seeing? I think this is for you, no? Okay, yes. Yes, we are seeing mergers between OEMs. And we understand that there's something that's completely natural and which makes economic sense. At the end of the day, in the last few years, we've seen OEMs facing mega investments, which individually there's no way they can manage to return. So these alliances, these cooperations between companies, what they're trying to do is to make these mega investments cost-effective. But also, we aren't just seeing it at an OEM level, like you've been asking. We're seeing it at all levels of the supply chain. We've seen it in OEMs in Tier 1 and in Tier 2. In fact, I think we're the best example of concentration in our space in Tier 2. Also, you were asking about the weight of OEMs in our customer pie chart. And it's true that they've been growing in importance. I think there are 2 reasons. Firstly, we think that the incorporation of Intervo roof systems in 2019, in which we sell directly to OEMs, has affected this pie chart. And secondly, another reason, I think it has to do with that intense growth we're experiencing in emerging markets like India, Brazil and Mexico, where Tier 1 is a lot less developed and where we sell directly to OEMs. So, let's keep going. You haven't mentioned the future shareholder remuneration policy. What can you tell us about this? It's my turn, isn't it? Yes, it is. Okay, I'm sorry, I forgot to mention the issue of the dividend. But of course, we're going to continue with the same dividends policy, which, as everyone knows, is a payout of 1/3 of net income. As we were already discussing in our presentation, growth in base net income is very significant in the next few years. So the same dividends will be increasing at the same rate. And don't forget that we're always focusing on shareholder profitability. And of course, we'll be able, as we did in 2020, to do a share buyback program to reduce capital again, as long as we understand that the market does not reflect the true value of our project. Next question. The lower level of maintenance capex in the last few years is remarkable. And this helps you in the goal of conversion ratio of operating cash flow. What can we expect in the future with regards to the maintenance of capex and growth capex? And here's another question. Will the growth capex percentage be different by geographical region? Okay, Lorea, this one's for you as well, please. Yes, I think this is a subject we've been discussing in the last few quarters. We're aware that over the last few quarters, the maintenance capex percentage has been dropping for several reasons. On the one hand, I mention again the integration of Inteva in 2019, because as it's a much less capex-intensive business than the rest of our Tier 2 businesses, it affects the maintenance of capex percentage. We also have made a conscious decision to stop investment, or at least considerably limit our investment in certain divisions, such as our German forges for MCI Europa. And lastly, I think another influence is the systematic control of capitalizations that we're rolling out. So with all of this, it's true that the traditional 4% is being left behind. Jesus Marie said a moment ago that we're going to invest around €1 billion over the next 5 years. This equates approximately to 5% of annual sales. Now, in this 5%, a little more than half, so between 2.5 and 3%, will be the part of maintenance capex, and the rest, 2 to 2.5%, will be the part of growth capex. I'm sure you already know that capex has to do with new expansions, new capacity. And to answer the question on regions, I'd say yes. It's more heavily focused on those regions where we're seeing very intense growth in the coming years, such as Mexico and India. So, let's keep going. We have 2 questions about electrification. First, how will you mitigate the fact that an electric car has fewer components than an ICE? And secondly, is your electrification strategy different according to country? Inigo. Yes, what's really important for CIE is not comparing the number of parts of an internal combustion powertrain compared to an electric powertrain. As we've tried to explain in the presentation, really, in the internal combustion powertrain, there are many parts that we really don't make. So what we have to do is to compare the target value that we have in parts that we make for the internal combustion engine compared to the potential value that we have in the parts we already make for the electric motor and those that we can make. So comparing everything to everything makes no sense for CIE. We need to compare the scope of CIE in the 2 engines. And if you do it like this, in any scenario, we end up winning. So we see many future opportunities. Regarding the different geographical regions, yes, we have different strategies in different geographical areas, but really, it's the market and the pace of electrification that shapes this. We're technologically prepared to follow the demands out there, but it's the demands and customers which are really going to set the pace in the different regions. Next question. What remains after the 19% in the Ebitda margin? Will CIE have achieved its maximum potential as regards profitability in 2025? Oh, what a question. Well, those of you who know me know perfectly well that my dream is to hit 20%. I'm going to tell you a little bit about how that works. When we carry out M&A transactions, we generally include companies with lower margins, so we become fairly diluted. This occurred, for example, in 2019 with various integrations, and we dropped to 16% of Ebitda. So the work to generate value in the next few years consists of increasing that 16% to 19%. As I said before, over the next 5 years, we're going to generate a lot of cash. So there will be important M&A transactions, and the same process again, the process of reducing margins initially, and then of generating value by increasing those margins. Great. The next question says, regarding growth, what organic growth can we expect in the period? What kind of outperformance of the market does it represent? Is this outperformance sustainable in the medium and long term? And is it in all of the geographical regions? A lot of questions. Go ahead. Yes, Jesús María was explaining a moment ago how the market over the next few years is expected to grow by approximately 28%, which would mean going from the almost 75 million vehicles which were manufactured in 2020 to the 96 million vehicles who are expected to be made in 2025. That growth would mean approximately 5% in compound annual growth rate, although things really aren't so mathematical or linear. And we're going to see years of strong growth, such as in 2021, due to the post-pandemic recovery, and then we're going to see other years of lower growth. This environment is the one in which Jesús María said in the guidance that we're going to grow more, not 28%, but almost 50%. This growth in sales that we're expecting would equate to a compound annual growth rate of almost 8%. However, just as I was saying about the market, our growth is not going to be linear and mathematical. There will be years of more growth, others with less growth, and there'll be years of greater outperformance and others where it's lower. What all these years have in common is the scenario in the background. And the scenario is very clearly a one of supplier consolidation, a scenario in which we see ourselves as winners. In the end, we're global, we're multi-technology. We can refocus our offer towards wherever demand is heading. We're able to invest. We have the financial strength to invest when the project requires us to. So, I think we're exactly what the customers want. Next question. What investment volume do you estimate you could undertake in M&A under the strategic plan, and how would it be distributed between the different years approximately? In which countries or technologies do you see yourselves investing more in M&A? Well, as you mentioned before, the considerable cash generation is going to mean, at organic level, a net financial debt to Ebitda ratio of about 0.5. If we don't want to exceed a net financial debt to Ebitda ratio of 2, we have 1.5 billion euros to make corporate investments. But the majority of them will be acquisitions of new companies. Regarding the periods, well, as you know, throughout our history, there have been years in which we have not integrated any companies, and there have been years in which we've integrated 3 or 4 companies. So it's very difficult to say exactly which specific year it will happen. Regarding technology, we're obviously talking about winning technologies, those which are going to be more in demand in the future. And when we talk about geographical regions, it's those regions with considerable growth ahead for the next few years. If you recall, in the guidance we gave in 2021, we're talking about 2 strategic successes. One was the subject of roof systems at a technological level, and the other was the growth we had in Asia, both in China and India. Now, regarding India, I'd like to mention that our subsidiary MCIE posits for the next few years huge growth in the Indian market and outperforming the market, and also very significant growth in margins for the next few years. Next question says, could the tightening of the regulatory and emissions goals in Europe or in other countries represent an obstacle to your growth? Inigo, over to you. No. Really, the fact that there's a change and an acceleration in the goals and timelines for the regulatory targets set out by authorities would have an implication, no doubt, for the OEMs, which are going to have to redirect and accelerate their investments. Later, there would be implications for Tier 1s, which have products linked to those regulations, and they would have to accelerate the development of these products and create newly generated products. But that's not our case. We're a process-based company. Our innovation concentrates on developing processes with the highest excellence and the highest efficiency, but not on creating new products with new features. For that reason, we don't need to make any disruptive investments, neither now nor in the future, in order to meet the demands of our customers. And it also doesn't depend on the pace of the regulatory frameworks. What's the financing strategy for growth? Is it possible that a capital increase will be needed? Is the sale of any of the divisions being considered? Well, of course, considering a capital increase at this point is impossible for two reasons. Firstly, from what I said before, considerable cash generation, which obviously is sufficient for all the growth in the next 5 years. And secondly, as you know, we also have a hard core of shareholders who don't want to open the way to a capital increase. When it comes to divisions, we have to remember that at CIE there are 25 divisions, and all of them are profitable. So we're not considering the sale of any division. It could happen that we have an asset that is not such a good fit with the profile of CIE, in which we could decide to sell for a reasonable price, but nothing significant, because as I said, the 25 divisions at CIE, and this is very important, are all profitable. Next question. What can we expect regarding the evolution of working capital? Do you expect any changes in policy? And what are the factoring levels you're assuming looking to the future? I'll leave this one to you as well. The answer is no. We don't expect any changes in the working capital policy. As you know, on the one hand, we have the net operating working capital, which is managed by the plants themselves. This doesn't include any factoring. And there we're very clear about what the policy is and what the goal is. The goal is to grow while trying to invest as little as possible in working capital, with no significant investment in working capital. On the other hand, we have the central financial department, which manages factoring. This factoring is non-recourse, and it's factoring that, well, as far back as I can remember, this has been following the same policy. That policy is that a maximum of 1/3 of the gross receivables is subject to factoring. So it's possible in the next few years, you've seen that the factoring level has been increasing in absolute value, but not due to a change in policy, not at all. The policy is the same, and we expect it to remain the same in future. Next question about Endeva. You've integrated Endeva with less than 9% in Ebitda. How is the integration going almost 2 years later? And what level of profitability is Endeva at? Is there a potential for it to improve further? Oh, that's a lot of questions together. Oh, yes. Well, it's difficult to address them all. But look, I'm really happy this question's been asked. I have only good things to say about Endeva. It's obvious that we've integrated a multinational in a completely different culture to that of CIE, but it's also true that over these 2 years, we've devoted ourselves, in part, to operational improvements, both in Europe and in the United States, and then to integrating CIE culture. As you know, our strict budgetary control, our financial discipline, our strict commercial policy, all of these improvements we've been able to make have meant more or less an improvement of 1%. Of course, we still have another 2 or 3 years ahead, with significant improvements that we'll be seeing and sharing with all of you. We're experiencing significant improvements, and I think that in the short term, you're going to see a company with double digits in EBIT, which is the same as you have in the rest of the group. And also, as Lorea said before, you have to understand that it's an activity, a business, that's not capital intensive. So Endeva generates cash flow, which is on a par with the rest of the group. Next question. Is there a risk that certain technologies in your portfolio will disappear because they become obsolete earlier than expected, or they become cannibalized by other technologies? No, we don't see any risk of obsolescence. In the presentation, we've also tried to explain the situation. We believe that all the technologies we have in the group at the moment have a future, and that they have a great future ahead. It's true that there are certain technologies which are more natural winners, such as the roof systems business, plastics, aluminium die casting, and metal stamping. Because in the end, these are the technologies associated with the future our customers are going to be demanding for the cars in future. In other technologies, we've also implemented a very exhaustive plan, both for the commercial side and for product and technology, to ensure our future. such as forging and machining technologies. It's also true that there are some technologies which are perhaps apparently less likely winners, such as casting technology. However, if we look at certain places which are becoming electrified much more slowly, such as in Brazil and India, and also some segments which are being electrified very slowly, such as heavy vehicles, we think that the future is clear, and undoubtedly there's considerable room for us. This question is directly for Jesus Marie. Do you have a team to tackle the organic growth you were talking about in the plan? And for inorganic, could human resources be a limitation? No limitation at all. I believe we have a magnificent top-level team, a team which is going to be responsible for taking on new challenges, and we have a second-level team which is absolutely ready to take on current operations. Bear in mind that over the last few years we've put a lot of work into the succession plan in all areas of the company. And also remember that we have to take into account that we have inorganic growth for which we always integrate personnel, and these people can also be key for the growth of our group. That was the last question. So, with this final block of questions, we've finished the Q&A. Thank you very much to everyone for taking part. Thanks for sending us in your questions. If anyone feels there are any questions which were not answered in full, please don't hesitate to contact us. We'd be very happy to answer your questions. So, here we end this CIE Automotive Capital Market Day. Thanks to everyone. Thanks to the team at CIE Automotive for helping to make this event possible. Thanks also to everyone who's joined this event in streaming. Today, we're setting out on a path paved with commitments and dreams to be fulfilled. Today, we also start the future together. Thank you.